Hello everyone, today is Friday, February 4th, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. If this is your first time tuning in, welcome. Thanks for being here. It's nice to have you. Here's how we break up our analysis. In part one of this video, we look at everything that went on in markets. We go beyond price action. We look at things like credit markets and term structure volatility and sector performance, market internals, really sort of just pick apart everything that stands out, looks different, interesting, unique, potentially informative. And then in part two, we jump into the charts. We look at the price action. We break down those longer term trends and try and make sense of everything as a whole. So hopefully that sounds good to you. Let's dive into some of the headlines from this week, some of the takeaways from this week. So first off, we got the bounce in the market. So if you tuned into last Friday's video, this is sort of what we were prepping for, or what we were thinking would be the likely scenario here. We had those big outside reversal weeks that we talked about last week. In part two, we'll sort of recap that just a bit. But we had the bounce set up for this week, and we got it. We, in fact, got right to sort of the resistance area that we sort of mapped out from last week, and we're going to talk a lot more about this in just a little bit. We obviously have earnings season that has been in full swing, and it has been some big swings out there. I think we were setting records on multiple days this week. We saw Facebook, I think, shed, if I have my facts correctly, the largest market cap overnight drop in history. So a company that size down 25, 26, 27% on a one-day move. That was huge. We had Amazon then come in on Thursday night and, report some spectacular numbers. They were up like 14, 15% with a huge, add to their market cap. So it has been all over the place, and it really does go to show you the signs of kind of the type of market environment we're in right now, with so much going on from a macro picture, and the market is trying to reprice everything. We saw Snapchat also have this just massive move where we saw a huge drop intraday followed by this monster move after hours. And so it's showing some of the dislocations and some of the repricing that is going on in this very volatile market. We also see treasury markets continue their sell-off. We saw the dollar saw an outside reversal. We're going to get into all of that throughout this video. So let's take a look at the numbers. If we take a look here at the right-hand column, we've got everything in the green this week. And once again, we are seeing international stocks outperforming. This is a trend where I think most of the audience probably tuning in here is mostly focused on the United States, but this has been something that is getting more and more obvious now, is that kind of overseas, outside of the United States, things are starting to outperform on a more relative basis. And in fact, if you are someone who likes to go into a country specifically, there's actually some even more opportunity there. That would take us to a very long tangent, so I'm not going to cover any of that in more detail, but it is interesting to note. You can see it on the 1 month numbers. If you look at the ACWX, which again is not a perfect index, but again, it's measuring kind of equity markets outside of the United States, you can see on a relative basis outperforming. Otherwise, though, you saw most equity markets in the US here up about 1.5% in a pretty even race amongst all of the indices. Now, if we take a look at market internals, things weren't as rosy as what the indices sort of lead us to believe. We did still see net negative or net 52-week lows being made this week, even though we did see the indices rise. So we had about 171 net 52-week lows made. AD line did stay positive, 900 to the upside, and the percentage of stocks over 20 SMA, you could see progressively sort of higher and higher throughout the week, about 47% as it stands right now. If we take a look at those 52-week highs minus lows, you can see this trend still is pretty ugly here. This is, again, just looking over the past 30 days, summing up how many new highs and lows were made across the NYSE, and you can see that the trend is still very much to the downside, and in fact, still getting more negative. So for me, this is all we really need to know to still be concerned about the market. Of course, we can always have these 2, 3, 4, 5, even 6, 7% bounces. When you sell off aggressively in individual stocks or bear markets, those reflex bounces can be equally as aggressive, but generally here, this is telling us that this is not the most pleasant investing or trading landscape to the upside right now. If we take a look at sector performance, you can see most things were in the green. We had energy back to the top of the list here. It's very, very much a standout in terms of this year's performance, frankly, last year's performance as well. XLE is up 13.8% over the past month, and this week it was up 4.92%. We did see financials in the second spot, 3.54% higher, and then consumer discretionary, 3.51%. If we look on the downside for this week, the three sectors in the red were communication services, real estate, and materials. Sector breadth. So this is a new piece of data that I included in this week's deck, and I have a lot of other data series. I just haven't had the time to get them updated. So I am going to start introducing some even more what I think is informative or interesting data sets. I'm going to potentially drop things instead of looking at always kind of the same pieces of data every single week. I'm going to try and just really present what's most interesting. And so I wanted to throw this one up this week here. This is sector breadth. And the way I'm measuring breadth in this measurement is the percentage of stocks over a 50 SMA. So what I've actually done is I've looked at how the individual spider sectors here, so those symbols are probably going to look familiar. You can just look to the left about what sector they are, and you can see this is how the percentage of stocks that are actually above a 50 SMA within those sectors. So you can see energy, actually every single stock in the XLE is above a 50 SMA. Financials, 72.6% of the stocks are above a 50 SMA. Utilities, communication services, and consumer staples. Very defensive tone here. Now, I highlighted these in green because more than half of the stocks are above a 50 SMA. To me, that's just a decent, reasonable cutoff level. Everything below here, you can see, of course, has much more negative breadth. So you've got essentially less than half of the stocks in all of the sectors down here are above their 50 SMA. You can see worst is consumer discretionary, which is pretty surprising, just given the Amazon move, but 14.75%, real estate 17.24%, industrials, only 23% of those stocks in that space are above a 50 SMA. So this gives a little more color and context to the specific numbers here. These numbers are great, of course, to obviously just know how we are performing on a week-to-week, month-to-month, or year-over-year basis, but this can give us some interesting insights, and there are different time frames we can use when we start looking at this data. So this is one of many kind of new pieces of information here that I'm going to start introducing into this video series. If we take a look at VIX, so volatility term structure here, you can see much healthier from the last time. And actually, so this data might be 2 weeks behind now that I think about it, because I did not get to update this chart last week. So in fact, I think this orange line is 2 weeks ago. So apologies for that, but I know we couldn't do the full length video last week, but the blue line is this week. And so that's what's going on right now. We got VIX kind of coming back down into the low 20s, and you got a slightly healthier kind of term structure going out in time here compared to what we had 2 weeks ago. If we take a look at interest rates and credit markets, so you can see yields were up, treasuries still getting sold off right now. It's very difficult to try and stick a bottom here. And again, makes maybe a little more sense with the equity market relief rally we saw, but still we're seeing yields up. But take a look at junk bonds here and even investment grade credit. They're selling off. They're going down, and this is not the direction you want to see. So again, this is more just sort of negative evidence when I look at this bounce as being maybe a short-lived bounce or a temporary bounce, right? That's what this type of information starts to make me think. If we take a look at the dollar, you can see was down pretty dramatically, which is, generally speaking, is a bullish sign, right? If we are going to see the dollar really unravel like that, that does tend to, again, give a little bit of a tailwind to equities. And we did see that, of course, this week. That's a relationship. That's a big down move in the dollar. We'll see how that follows up next week. Gold, silver, Bitcoin, ag, WTI, everything enjoying the move up, except for natural gas was down. Still seeing lots of volatility there. So put it all together, report cards, pretty mixed bag here. We've had a couple of things that were, still, getting us the check marks there. We see some of the right sectors that are outperforming. We saw obviously equity market performance just from a price perspective was higher, but breadth, VIX, credit markets, those are all things that are still giving us a concern. So for this week in the bounce here, we're giving it a C. That is the report card for this week. Now, if we take a look at our trading systems here, of course, you can see now much more, defensive tone to both of these trading systems. So our Merlin longer term strategy, as was and has been the case this year, it's essentially been de-risking, sort of distancing itself a bit is the way you could think of it from equity market, and just sort of reducing that exposure. You can see we've got mostly cash still invested here in some positions that it likes, but certainly a bigger cash buffer. Our shorter term trading system now is net short the market. It moved net short later on in this week. It is mostly cash though, right? You can see it's basically 90% cash. So what it's basically saying is it doesn't want to have a strong opinion right here, a little bit of a tilt to the downside, but basically it's kind of just waiting and seeing at these current price levels. So we've got a lot more information on both of these trading systems. Got a new $1 trial sequence, which tells you a lot more about how they work and how they might be the right fit for you. So do check that out with the link in the top right and explore some of our other pages on the website on these two trading systems. But with that, we'll be back here in just a minute with part 2. Okay, we are back. We've got TC 2000 open. We're looking at our equity market grid. We have a custom indicator that we've developed. It's called our Smart Trend Filter. That's applied to all of these charts. These are the multicolored dots you see. Helps us measure trend via price and volume over time. And we are looking at a weekly time frame. So let's start in the top left. S&P 500 still is the only index here that is holding out from producing a fresh sell signal. This is still in its yellow transition state. It is below our smart trend filter indicator. So that is telling us that it is likely, the odds are increasing that we're going to get a sell signal here, that trends are reversing and things are breaking down, but it hasn't quite got there yet. And again, if we zoom all the way back out, sell signals don't happen often. They typically are during the more extreme sell-offs and corrections. Last time was 2020. So we're hanging out here in the S&P 500. Let's see how this week follows up. If we take a look at the Nasdaq in the top right, you can see this did produce a sell signal last week, and this has confirmed a trend change here on the long-term time frame. Again, zooming all the way back, you'd have to go to 2020 to see the last time a sell signal was produced. So again, this also gives us, from a objective price and volume longer-term trend perspective, that we want to have a glass half empty bias. Russell 2000 in the bottom left, this was the first to turn down 3 weeks ago, produced its first sell signal. And even though we are still seeing relative outperformance out of international stocks, we did get a sell signal produced here as well. Let's go to the daily chart. Let's take a look at all these markets from the daily chart. And you can see, again, things are mostly pessimistic, glass half empty here. So on the daily chart, the S&P 500 produced a sell signal back on January the 18th. The Nasdaq first back in even earlier January, and then the Russell 2000 again, middle of January. It's basically been the same thing for these markets. Of course, now you can see with these bounces, we're starting to get back into neutral choppy territory, but still you've got this, prior signal, which is a sell signal in all of these markets. So let's take a look at some price action now. Let's, take a look at some levels, what everybody likes to look at, and just kind of measure and map the high level here. Now, when we did our video last week, this was how we framed it out. We kept things extremely simple, and we essentially looked at this level down here around 4,300 and this band right up here around 4,550. And so the thought process last week when we had our video, when we had this session, so this is what we were looking at. dial it back one more. And there it is. So this was last Friday's video, and we essentially looked at this. We looked at the weekly chart. We looked at this big hammer down here. We looked at Bollinger Bands on, you know, a weekly time frame. We looked at how we pierced below it. We reversed on such heavy volume. We found support at a very important 4,300 zone, and we essentially framed out this upper level here as a reasonable bounce target. And so we did get that follow through. We got nice 4 days of buying right up and exceeding this 45.50 area, and then we sort of dropped back below it, and you can see we're starting to find some resistance right at this 45.50 zone. So that's kind of the roadmap here of what happened. We came kind of ramping, roaring right back into resistance, maybe sucked in some, chasers that were essentially looking and thinking, okay, everything's fine again. And now, kind of pulled the rug a little bit and sold off. So when I sort of look at this market now, this is where I want to be much more cautious in the very short term. So we just finished up part one where we see breadth on a longer term basis, which is still concerning. We see credit markets, which are concerning. We see individual sector breadth that is concerning. And when we look here at a market that has just moved, 7% off of the lows, or put in basically a 50% retrace, coming back into resistance now, this is where I want to be essentially lightening up, or just certainly being more tactical. If I am long, I just want to have good quality stocks that are maybe outperforming the market, or I want to have my stop losses in, so on and so forth. Again, it's tough to speak to all time frames at once. So I'm speaking now to the short term. I want to be cautious in this area here. Now, again, it doesn't mean I don't think that the market can go higher. In fact, even if this stick here can hold on Friday, maybe another second test up here around 4,600 to retest these highs early next week, certainly in the cards. But again, I just would not want to be too excited. I don't want to be that last buyer up here trying to buy at resistance after we have, already rallied off of lows, and it looks like we're trying to form new downtrends. So that's what I want to be cautious of at this current spot. So for me, S&P 500, if we want to now get a little bit cleaner in our levels, right? So if we want to get a little cleaner, what I'm essentially going to be looking at here is just the highs from last week, Wednesday specifically, right around 45.95. So right in here is what I would be paying for close to a reaction to. But generally speaking, back to this old level over here, the longer we stay below this 45.50 area and we can't crack above it, I do want to be cautious. And I do think that a move back down into 4,300 is definitely possible. So for me, this is kind of the new playground that I'm seeing, I could envision the market being in, call it 4,600 to 4,300 and just a bunch of chop through here. To me, the catalyst to get through 4,600 seems pretty difficult at this time. I don't know if that's, again, I don't want to get too much into fundamentals or economics, but I don't know, unless the Fed reverses course pretty quickly, or we just see some massive blowout numbers through the rest of these companies, which I don't even know if that's enough to do it. I just want to be more cautious right here, right? All signs point to being a little bit more cautious. So if you're tactical, if you're active, you want to be long and you can manage risk, absolutely. You can make a lot of money on both sides of the market right now. But generally speaking, if I want to be, objective here on just more broadly, I'd say cautious in this zone. If we take a look at the Russell 2000, again, we're still seeing generally some relative underperformance here. It did close up 1.6%, still getting, resistance up here around 203. We've got all this prior supply after breaking down, and we're trading below it. So again, I want to be cautious. Nasdaq 100, Again, very similar to the S&P 500. Again, still a little more pessimistic though than the S&P 500. I know we did see the 25, 27% drop in Facebook, but we also had an even larger company here, Amazon, report 14% to the upside, and Nasdaq 100 still only closed up 1.77% this week and well off of its highs. So for me, again, just speaks to more cautiousness. Would I be surprised if we got back up and retested 370 zone? No, not really. But generally speaking, again, I just don't want to be the buyer, or certainly not the buyer without a plan. So as you can see, I'm a little more cautious on this market, and I do think risks are opening, have potential to move back down towards those prior lows. So chop sideways, that's the way I'm looking at it, with a downward bias. So that I think is pretty clear on all the majors. Let's run through a few other charts. TLT, I want to talk about that. So TLT, you can see here, just can't get any stabilization. This is still treasuries that are selling off. You can look at Bollinger Bands now. It's starting to get back below it. So TLT starting to break down here. I do think we have some signals in that for next Monday, but I got to run through those signals. You can look at IEF as well, which is just basically the 10-year treasuries, and you can see again below Bollinger Bands. So certainly oversold. Maybe this is the washout move, but still trying to find some of these bond funds to really start to stabilize. We also got the VIX, which we talked about briefly earlier, back down in the low 20s. Does seem like 20 wants to act as support right now. So again, for me, a little bit cautious here as we hang up into the 20s. What else can we talk about? Gold still kind of chopping around. I'm still pretty bullish generally on gold, or at least as a relative outperformer. It was definitely a letdown here as this kind of came, swiftly kind of breaking back down below this 170 zone. But, generally speaking, I do think GLD, on a relative basis can outperform, even equities here for the next week or 2 or 3 weeks. But again, we'll have to continue to see that prove itself out. And oil breaking out to new highs. Amazing move here that is still just not letting up. You can see these trends still just riding above like a 10 SMA, 5 SMA, very, very strong here. And it shows in XLE and a lot of those companies. So let's finish off with some individual sector and industries. There's not too much to look at here. So basically some standout sectors on the upside. We saw electronic gaming, which was real strong this week, 7% to the upside, strong volume, close at the highs here. Still, in a tough spot on a relative basis, but in terms of weekly performance, it was notable. And then everything else is energy. That was it. I mean, we basically had electronic gaming and multimedia, and then we have just oil and gas. So oil and gas breaking out, potentially breaking out to new highs. That's drilling. We got E&P here breaking out to new highs. We got midstream breaking out to highs, and then we got refining and marketing breaking out to new highs here as well. On the downside, we had a big bearish reversal here in credit services. So we got this big long tail in here, heavy volume, close at the lows. So this underperformed the market today. And then we saw in the consumer defensive pharmaceutical retailers specifically, we saw a close at new multi-month lows this week, underperforming on a relative basis. So that is the full roundup for this week. Hopefully everyone navigated it okay and is in one piece. Leave us your thoughts in the comments section below. Let me know what you're looking at, what you're paying attention to heading into next week, and just what your general sentiment is about this market. So I'd love to hear from you. Love the feedback. Thanks as always for tuning in and watching every Friday. Long form market analysis. Subscribe to our YouTube channel if you want to stay up to date, or follow us at thetraderist.com. Have yourself a great weekend. We'll see you back here next week.